In today's session, we've had a couple of questions from various subscribers asking about some of the recent policy comments we've had from central bankers, as well as some central bank statements. And the questions mostly revolved around how we can go about better interpreting these types of comments. Now, the first thing I want to say about this is learning how to interpret something like economic data, for example, is a lot simpler in my opinion because there's only so many variables that you need to take into account. But when it comes to interpreting whether someone's tone or language is more positive or more negative, or in trader talk, leaning more hawkish or leaning more dovish, is one of the more complicated parts in trading, in my opinion. So if you look at some of these comments from central bankers or policy statements and you just can't seem to get why it was more hawkish or more dovish, then don't feel bad. This part does come with a little bit of nuance. It does take a little bit more time getting used to it, and is also sometimes a bit more subjective, depending on whether the market chooses to focus on specific parts of a central bank speech or only certain parts of a policy statement. So the good news is that there is three questions that I think can really help you to better interpret comments and speeches or press conferences or statements. It's three questions that has helped me a lot in evaluating the tone and the language, and it often provides a little bit more clarity on how the market ought to react. Now, I say ought to react because sometimes the market does the exact opposite, of course, of what it ought to do. So these three questions is by no means a holy grail of understanding tone and language. It's just a helpful way of making a little bit more sense of it. So the first question going into any speech or policy event is to ask yourself, what is the market expecting from this particular central banker or from this particular central bank in terms of the statement or the tone? Are they expecting a dovish or a hawkish tone from them? And this is the most important step because it gives you context to whether the actual tone or language was in line with what the markets were expecting. The second question then is, did the tone reflect what the markets were expecting in the first place? If it did, then the market reaction is most probably going to be a more muted one. If the answer is no, then you need to think about how much it diverged from the consensus expectation. So, for example, there is a very big difference between markets expecting a dovish tone and then getting a hawkish comment compared to markets expecting a hawkish comment and getting a slightly less hawkish comment, if that makes sense. So depending on how far the tone has moved away from the expectations, that will determine the potential size and sustainability of the subsequent reaction that we see in the prices. The third question is, does anything in the comments or the tone or the language, does it actually change the overall monetary policy outlook or the bias? Now, if the comments diverge from expectations, but it doesn't change the overall expectations for monetary policy, then we can expect a more short-lived reaction, maybe an opportunity to take advantage of from an intraday perspective. Now, if the answer is yes, however, that it was significant enough to actually change, did it change the market's expectations about interest rates or policy tools in the near term or in the long term? So, for example, if everybody was expecting more quantitative easing from a central bank, and the bank's language and tone suggests a move away from easier policy in the near term, then that will, of course, cause a repricing of quantitative expectations, and that would be a more sustainable reaction in the price. Now, on this, it is also important to evaluate, like we said, how much the repricing needs to change. So, for example, if the markets expect a bank to cut rates next month, and the bank has a statement and it's less dovish than the markets were anticipating. Now, that might lead the markets to think that there will still be a rate cut, but the rate cut might only be 3 months away instead of next month. So they still expect a rate cut, right? So it changes the expectations not from a cut away to a non-cut, but it changes the cut away from next month to 3 months away. Now, if the bank was expected to be dovish and they come out overly hawkish, then that might cause expectations of the cut that was expected to come in a month's time to zero cuts going forward. Now, there's obviously a very big difference in the type of price moves we can expect between those two different scenarios. So guys, I hope that these 3 questions has been helpful in allowing you to interpret the central bank tone and language a little bit better, and placing it in a little bit more context whenever you hear these types of comments, and then obviously what type of price moves we can expect from them. So as always, any other questions, please don't hesitate to let us know.